The global economy is facing strong headwinds. Growth is slowing. Inflation remains stubbornly high. Many fear a recession is looming. These challenges are interconnected and demand careful analysis. We must understand the causes and consequences of this economic storm to chart a course towards recovery. The current economic climate represents a stark departure from the robust growth experienced in the aftermath of the pandemic. Government stimulus measures and pent-up consumer demand fueled a rapid but unsustainable surge. Supply chains struggled to keep pace, leading to inflationary pressures. Now, central banks are raising interest rates to combat inflation, risking a slowdown. This economic uncertainty weighs heavily on businesses and consumers alike. Businesses are hesitant to invest and hire, fearing a downturn. Consumers are grappling with rising costs for essentials, eroding their purchasing power. The stock market, a barometer of economic sentiment, has experienced significant volatility, reflecting investor anxiety. Navigating this complex landscape requires a nuanced understanding of the forces at play. We must examine the confluence of factors that have brought us to this point. Only then can we begin to formulate effective solutions to mitigate the risks and pave the way for a sustainable recovery. The current economic downturn is not the result of any single factor, but rather a confluence of interconnected global trends. The COVID-19 pandemic, while seemingly receding, continues to cast a long shadow. Supply chain disruptions persist, fueled by factory closures, labor shortages, and transportation bottlenecks. This has contributed to rising costs for businesses and consumers. The war in Ukraine has further exacerbated these challenges. Sanctions on Russia, a major energy and commodity producer, have sent shockwaves through global markets. Energy prices, already elevated, have soared, pushing up the cost of transportation, manufacturing, and food production. The conflict has also disrupted global trade and investment, adding to economic uncertainty. Monetary policy decisions, particularly in the United States, play a significant role in the global economic outlook. The Federal Reserve's aggressive interest rate hikes, aimed at taming inflation, have strengthened the US dollar. While intended to curb domestic inflation, these rate increases can have spillover effects on emerging markets, making it more expensive for them to service dollar-denominated debt. Furthermore, geopolitical tensions, particularly between the US and China, add another layer of complexity. Trade disputes and technological competition between the world's two largest economies create uncertainty and dampen investment. These factors, combined with climate change impacts and demographic shifts, create a challenging backdrop for economic growth. The economic challenges outlined above have wide-ranging consequences, impacting interest rates, wages, and stock markets across the globe. Central banks, tasked with maintaining price stability, have responded to rising inflation with tighter monetary policy. Interest rate hikes, while intended to curb inflation by cooling demand, also make borrowing more expensive for individuals and businesses. This has a direct impact on wages and employment. As businesses face higher borrowing costs and economic uncertainty, they may be more hesitant to invest, expand, or hire new employees. Wage growth, while positive in some sectors, struggles to keep pace with inflation, eroding purchasing power and putting a strain on household budgets. This dynamic further dampens consumer demand, potentially slowing economic growth. Stock markets, reflecting investor sentiment about the economic outlook, have experienced significant volatility. Concerns about inflation, rising interest rates, and the potential for a recession have weighed on stock prices. While markets have shown resilience at times, uncertainty persists, making investors cautious. This volatility can impact retirement savings, business valuations, and overall financial stability. The interplay between these factors creates a complex and challenging environment for policymakers, businesses, and individuals alike. Understanding these ripple effects is crucial for navigating the current economic climate and making informed decisions. Predicting the future trajectory of the global economy is, well, inherently complex, but several potential scenarios warrant consideration. One possibility is that inflation gradually moderates, allowing central banks to ease up on interest rate hikes. This scenario, often referred to as a soft landing, would be welcomed by businesses and consumers alike. It would allow for a period of sustained, albeit potentially modest, economic growth. However, there are also risks of a less favorable outcome. Inflation could prove more persistent than anticipated, forcing central banks to continue raising rates aggressively. This could trigger a recession characterized by job losses, declining economic output, and financial market turmoil. Such a scenario would have significant consequences for individuals, businesses, and the global economy as a whole. Another possibility is a period of stagflation, reminiscent of the 1970s. Stagflation is characterized by stagnant economic growth coupled with high inflation. This scenario presents a unique set of challenges for policymakers, as traditional tools to combat inflation, such as raising interest rates, can exacerbate the slowdown in economic activity. Navigating stagflation requires a delicate balancing act. The path forward remains uncertain, and the likelihood of each scenario depends on a complex interplay of factors. These factors include the trajectory of inflation, the pace of interest rate hikes, the resilience of consumer demand, and the effectiveness of policy responses. While the global economic outlook presents challenges, there are steps policymakers and individuals can take to navigate towards recovery and build a more resilient future. Fiscal policy, which involves government spending and taxation, can play a crucial role in supporting economic activity. Targeted investments in infrastructure, education, and clean energy can create jobs, boost productivity, and foster long-term growth. Monetary policy, while primarily focused on controlling inflation, should also consider the potential impact on employment and economic growth. Central banks need to carefully calibrate interest rate hikes to avoid triggering a recession. Clear communication and forward guidance from central banks are essential to manage expectations and reduce uncertainty in the markets. Addressing supply chain vulnerabilities is paramount. This requires international cooperation to diversify sources of goods and reduce reliance on single suppliers. Investing in domestic manufacturing capacity, particularly in critical sectors, can enhance supply chain resilience and reduce vulnerability to global disruptions. Promoting innovation and technological advancements can also lead to greater efficiency and flexibility in supply chains. Furthermore, investing in workforce development and skills training is crucial to equip workers with the tools needed for the jobs of the future. This includes supporting education and training programs in high-demand fields such as technology, healthcare, and renewable energy. A skilled workforce is essential for driving innovation, productivity, and economic growth. The global economy is facing a confluence of challenges, including high inflation, rising interest rates, and slowing growth. These challenges are interconnected and stem from a complex interplay of factors, including the ongoing impacts of the pandemic, the war in Ukraine, and geopolitical tensions. The path forward remains uncertain, with potential scenarios ranging from a soft landing to a recession. Navigating this complex landscape requires a nuanced understanding of the forces at play and a commitment to collaborative action. Policymakers must carefully calibrate fiscal and monetary policy to support economic activity while controlling inflation. Investing in supply chain resilience, workforce development, and innovation is crucial for building a more robust and sustainable economy. By understanding the causes and consequences of the current economic storm, we can chart a course towards recovery and a more prosperous future. Like, share, and subscribe for more insights on navigating the economic landscape.